Welcome to Delphos Insights. This deep dive is designed for you, our listener, especially if you're focused on understanding the complex structural shifts happening right now in emerging markets finance.
Exactly.
Our goal today is to really dig into the key trends and the data points that define 2025 and use that to set the stage for what looks to be a critical 2026.
We're analyzing a collection of specialized insights focused on how emerging market and developing economies, or EMDEs, manage to raise capital amid, well, persistent global economic weakness.
And it seems like 2025 was a real inflection point.
It was a pivotal moment. The data suggests it was defined by three things: unexpected resilience, a real scarcity of capital, and an urgent need for innovative financing.
Okay, let's unpack that. We want to move beyond just the day-to-day volatility reports here.
Right.
We're trying to understand the deeper structural changes reshaping investment priorities. Volatility is just the noise on the surface, but what's the current underneath?
I think that's the right way to look at it.
So the source characterizes 2025 as a demanding macro backdrop, yet EMDEs showed this resilience. What were the core global economic conditions they were navigating?
Well, the global economy was, to put it simply, running out of steam. We faced substantially weakened growth momentum, slowing very sharply in many developed markets.
And that had a number, right?
It did. Overall, global growth fell to 2.3%. And what's important about that number is that it's one of the weakest non-recession growth levels we've seen in the last decade.
So that low growth creates a huge headwind. How did EMDEs manage to push back against that?
They actually showed quite a bit of strength. EMDE expansion was projected at 3.9%.
Which demonstrates a pretty healthy growth differential over the developed economies.
Exactly, and that's what's attractive to investors who are hunting for yield. But, the report does temper that optimism. You mentioned it remained below the necessary trend.
Right, what is that necessary trend, and what's the risk if they stay stuck at 3.9%?
The necessary trend is the rate you need to actually narrow income gaps and lift large populations out of poverty. So while 3.9% is resilient, it isn't really transformational.
And that resilience came at a cost.
A big one, particularly on the debt side. Roughly 40% of low-income countries were in or at high risk of debt distress.
40%. That's an alarming figure. And that vulnerability was driven by higher global borrowing costs, wasn't it?
Precisely. The sustained high interest rates, tightening financial conditions worldwide made borrowing extremely expensive. So to raise capital now, sponsors need credible reforms and, very transparent structures.
The bar for quality and governance is just that much higher.
It has to be. And this high cost of money leads directly into what the report calls a structural shift. Capital scarcity is becoming entrenched.
That sounds daunting. I mean, what scale of investment are we actually talking about here? What's needed to meet development goals?
The numbers are colossal. EMDEs face annual investment needs of about $7.5 trillion US.
$7.5 trillion annually.
Annually. That's to achieve their combined development, climate, and biodiversity targets, the SDGs. It's just a sheer, non-negotiable amount needed every single year through 2030.
And public budgets can't cover that.
Not even close. Public budgets cover less than a third of those requirements. This structural shortage locks EMDEs into a heavy reliance on private and blended capital to raise funds at that scale.
Okay, so this is where it gets really interesting. The scarcity is being felt everywhere, but where's the pain felt most acutely?
It's being dominated by the climate imperative. Climate action alone requires an estimated $2.4 trillion annually through 2030.
So a third of the total gap is just for climate.
A third of the total is just for climate. It forces a terrible choice between basic development projects and essential climate adaptation. And on top of that, project finance inflows actually declined for a second consecutive year.
Which is terrifying for developers. Why the decline?
It's due to higher risk premia and just rising financing costs. It's the market's reluctance in action. This enormous $2.4 trillion figure illustrates that widening gulf between ambition and available capital. It's redefining how countries have to compete for these very limited long-term funding pools.
So capital is clearly moving based on very specific risk and reward calculations. The report broke down investment priorities across three key regions: Africa, Asia, and Latin America. Let's dig into those.
Sure, let's start with Africa. Despite the global headwinds, GDP growth there rebounded to 3.7%.
And where was the investment focus?
It was highly specific. Energy, especially renewable energy, transport, and digital infrastructure, these are really the foundational blocks you need to support rapid urbanization.
But Africa has that structural challenge of severe fiscal constraint. You mentioned debt service burdens are exceeding 25% of government revenues in some cases.
That's right.
So if a quarter of your revenue is going just to service debt, how are you supposed to fund that critical infrastructure?
It means the investable pipeline tightens dramatically. It forces capital towards projects that are, ring-fenced or self-sustaining, things like digital financial services or climate-resilient infrastructure that often gets concessional funding.
Okay, so let's shift east. Developing Asia, it remains a global powerhouse, projected for 4.8% growth in 2025. What's powering that?
It's being driven by really resilient domestic demand and expanding services. They're just less reliant on volatile global trade than they used to be.
And within Asia, South Asia is the real standout, right? The world's fastest growing region at 6.2%.
That speed and scale demands capital. So the focus there is heavily on digital public infrastructure, supply chain modernization, and these very large-scale climate-aligned renewable energy investments.
And finally, Latin America. The region was a huge story, capturing 66% of world capital inflows in 2024. That's a massive achievement in a time of global scarcity.
It is. It reflects a very successful environment for investment. This was supported primarily by the global reallocation of supply chains, the nearshoring trend, and critically, by targeted domestic reforms.
So investors are seeing stability in the policy environment there. Where is that patient capital going?
The key areas are agribusiness, renewable energy, low-carbon initiatives, and these global energy transition projects. The combination of policy improvements and attractive valuations is really drawing in long-term capital.
Let's pivot to investor behavior then. We know investment volatility persisted all through 2025.
It'll be constant.
Portfolio flows were extremely reactive, driven by shifting interest rate differentials and a fluctuating appetite for risk. How does that affect EM assets?
It's like a game of musical chairs. When liquidity tightens, everyone scrambles for the exit, and EM assets are often the first ones sold, and this is all amplified by the diverging monetary policies between developed and emerging markets.
Given those pressures, where's the sort of time bomb ticking for EM sovereigns? What's the biggest risk on the horizon?
The time bomb is refinancing pressure. It's projected to peak in a very tight window between 2025 and 2027.
So heightened rollover risk.
Heightened rollover risk across several EM sovereigns who need to find new money just to pay off old debts. This rising sovereign risk changes the entire calculation for investors.
And what about sustainable finance? GSS issuance is massive, approaching $3 trillion. Is that volume actually reaching the markets that need it most?
Unfortunately, no. Only a modest share of that GSS issuance actually reached the EMDEs. And that lack of access is why blended finance has become such a vital mechanism.
Right.
Blended finance mobilized about $14 billion in private capital. And importantly, adaptation-related structures deals focused on helping countries manage climate change, they increased by over 30% year on year.
This is where the MDBs and DFIs become so critical. How do they actually perform that de-risking function to bring private capital in?
They're central because they step in to absorb the first layer of risk. They act, essentially, as an insurance policy. They'll provide a credit guarantee or junior capital to persuade a cautious private investor to come in.
The crowding in effect.
Exactly. And this is complemented by policy momentum. Governments upgraded their PTP frameworks, expanded incentives. However, the report closes this section with a significant warning. Over 60% of EMDE banks now face material climate-related credit exposure. That's a huge systemic risk.
So what does this all mean in concrete, practical terms? The source highlights several flagship transactions that show how EM finance is adapting to these challenges.
Right. These examples show the strategic deployment of over $300 million in long-term capital, which proves that this complexity can be navigated.
Let's look at the first one, infrastructure. A long-term financing deal for a $125 million airport expansion in West Africa. Given the debt constraints we talked about, what made this deal fundable?
The success here was likely tied to the project's clear revenue stream, which was separate from the sovereign's general budget. Projects that self-fund and involve private expertise are getting prioritized.
It's all about operational discipline.
It has to be. Then the second and third examples address financial inclusion. One was a senior debt facility of up to $20 million for a digital lender in Asia.
So that's a bet on fintech venture activity.
Absolutely. It's to scale app-based credit for underserved households and small businesses, where traditional banks often fail. And that's echoed by another deal, a $10.6 million debt facility to expand SME lending in Latin America.
Which is crucial to ensure that local businesses can participate in the growth from all that foreign investment.
Precisely. And finally, a really strong frontier market example. a $150 million refinancing for the Mongolian Mortgage Corporation.
Why is that deal singled out as an example of resilience?
Well, Mongolia faces specific, elevated geopolitical and commodity risks. A successful refinancing there shows you can use financial structuring to diversify funding sources, moving away from volatile local capital and achieving long-term stability in a really challenging place.
These case studies really drive home the point that success requires navigating this systemic complexity with discipline and with data.
Looking toward 2026, the report suggests a clear, ongoing need for flexible structuring and extremely rigorous scenario analysis. The simple reality is the capital gaps will persist, making the landscape increasingly competitive.
And the need for specialized, localized approaches is clear. Past performance is really becoming a weak guide in emerging markets, where policy, climate, and geopolitical risks can just shift so rapidly.
Right.
The key lesson from 2025 seems to be that innovation and disciplined engagement are essential to creating both impact and financial value.
And we can't avoid the centrality of climate and resilience, not with that $2.4 trillion annual need. Tapping private and blended finance is no longer optional. It is a fundamental necessity.
So considering the persistent structural capital scarcity, the peak refinancing pressures hitting now through 2027, and that urgent need for climate adaptation funding, what element of project structuring will be most critical for investors who are seeking stability in 2026?
I think it will be the demonstrable robustness of the project's policy framework. With sovereign balance sheets under so much pressure, investors are going to prioritize structures that clearly insulate revenue streams and ensure stable regulatory environments. It's about signaling that the project can withstand future debt crises and geopolitical shocks. The future isn't just about finding new capital, it's about restructuring existing balance sheets to withstand the inevitable.
This has been Delphos Insights. Learn more at delphos.co.